property investing is a long-term asset, and it's difficult. It is difficult. The type of property and the quality of property that you invest in is more critical today than what it was 10, 20 or 30 years ago. A lot of investors think about return well before they think about risk, but it should be the other way around. If that's not clear and there's no evidence that it's happened in the past, then all you're doing is throwing darts at a dartboard.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day, Stuart. Thanks for joining us on the podcast again. I know our listeners love your episodes, so looking forward to diving deep into a new topic today.
Yeah, great to be back with you again, Jared. Thanks for the invite.
Now, of course, you're my financial planner, and I love listening to your podcast, Investopoly. And some time ago, you had a topic that property investors need to be more fussy. And as soon as I listened to this, it just struck a chord, and I thought, I've got to share this with my listeners as well, because it really hits home as to, you know, some of the more longer term considerations that you can't go back and change once you get too far down the road. So tell us about your position on being more fussy and how you came up with this.
Well, I think, you know, if you look back over the last, let's think quite long term, because I mean, at the end of the day, property investing is a long-term asset, and it's difficult. It is difficult psychologically for human beings to get their head around large numbers and head around compounding. It just doesn't come naturally to us. It's easy to think, what could a property be worth in 3, 4, 5 years from now? But it's really difficult to conceptualize how much it could be worth 20 years from now. But be that as it may, let's just talk about, you know, really long-term trends. And so if we look back to the last 20 or 30 years, you probably could have bought any property anywhere in Australia, almost, obviously not to the extremes, but in any of the capital cities, and done pretty well. Do you know what I mean? You're probably sitting on, you know, maybe it's 3 or 4 times the worth what it is today compared to what you paid for it. You know, you have a lot of equity in the property. It's probably positive cash flow. You know, it's paying for itself. It's delivering an income stream and so forth. And really, in a rising tide, all ships rise. And so I think that's certainly what Australia has benefited from over the last 30 plus years, is a rising tide. My concern though, Jared, and the reason I wrote the blog is, will that rising tide continue? Because there's been a lot of sort of talk, and there's continual talk around housing affordability. You know, if house prices are rising much faster than people's incomes, how will we ever be able to continue to afford to own property? And at a macro level, at a total level, that's correct. Now, what the biggest factor that's contributed, I mean, there's lots of factors that have contributed to rising prices in Australia.
Yeah, it'd be good to go back through some of those, because I know they've been pretty significant, haven't they?
Yeah, that's right. You look at population growth. I mean, Australia's population growth over the last 30 years in a developed economy has been very high compared to other developed economies. You've got income increases as well. I mean, they don't always reflect in those wage price indexes and so forth that the RBA look at. But certainly there's a cohort of Australians that have a much higher earning capacity today than what they did 30 years ago, partly because, you know, I'm sitting in Melbourne and I can interview for a job in New York if I want to, particularly if I'm working, you know, I don't have to attend the office and so forth. So globalization and work from home has certainly helped people increase their earning capacity. But really the biggest contributor, in my opinion, is borrowing capacity. And if we look back in the 80s and even early 90s, it was a very regulated industry. You had the big 4 banks, and it was very antiquated, quite old-fashioned, very conservative. And really, Aussie Home Loans was probably the first business that got into the mortgage lending market that really brought a lot of competition. And then the internet has then helped that competition 2 ways. Firstly, it's been easier for smaller banks to compete with the larger banks just online and to get a bit of a presence. They don't need branches. Yeah, particularly today. I mean, I don't know when the last time you walked.
The big 4 seem to be closing their branches at the moment. 1 minute you got somewhere to visit, the next minute they're not there.
I mean, no one's even using cash these days. So, so internet has helped that. And then internet has helped inform people, help people make really better informed decisions. So even around borrowing capacity, for example, if you wanted to find the lender 30 years ago that was going to lend you the most so that you could get into the property market, that's a lot of footwork and a lot of talking to different people and visiting branches and bank managers and those sorts of things.
Yeah, you'd almost get stuck and then you'd hit the wall and that would be it.
Today it's a Google. You could Google that or even just contact a mortgage broker and they'll do all the work for you. So 30 years ago, your borrowing capacity was about a third of what it is today. If we're looking at sort of how much can you borrow compared to your income and how much can people borrow compared to their income today, 2 to 3 times it's changed over that period of time, partly because of competition, partly because of deregulation, partly because of deregulation of the banking industry, but better regulation of, how banks approve and provide lending as well. But if we then ask ourselves, will that repeat itself? Like, will borrowing capacity be 2 or 3 times higher again in 20 or 30 years from now? I just can't see it. I think it's just a different regulatory environment. If you go back 20 years ago, when I started my business, to go and apply for a loan was a very simple process. They barely asked any questions. You barely had to provide any documentation. It was very loose.
I remember around those times it was no doc loans and, you'd just sign a piece of paper virtually and saying you can afford it, and there was no real vetting and you could get 70% no doc loans. And it was, yeah.
That's right. I remember doing some of the first loans we did. The client went and purchased the property, we settled, and then they came to us and, we don't actually have a loan application for this. We better get an application form signed. Like, it was very, very loose. These days they want almost fingerprints and, blood types and all those sorts of things. They'll ask a whole heap of questions. So if we can't rely on rising borrowing capacity, then arguably we won't have a rising tide over the next 1, 2, 3, 4 decades, whatever it is. And therefore, it's my view that the type of property and the quality of property that you invest in is more critical to today than what it was 10, 20 or 30 years ago because of that sort of rising tide, mostly because of borrowing capacity.
Well, the other structural shift that happened in that period as well is that we went from, single income households where my mum was a stay-at-home mum and that was her job. She might have had a little bit of part-time work here or there, but never even contemplated going back full-time. And these days, the double income is pretty standard. So what does that do for a household's borrowing capacity as well? I mean, you'd see it just on the financial side from people. So it makes a big difference.
Yep. Well, my parents bought their first home, I think in the early 70s. My mum was working and the bank manager wouldn't even take her income into account. You don't take the wife's income into account. So it has changed. It has changed a lot, of course. And look, sometimes people will go or will sort of test that thesis in terms of rising tide and try and pick properties or locations that are likely to provide above average growth or, sort of the next growth suburb or those sorts of things.
The hot spot.
So, yeah, that's right, the hot spot. So I'm not saying that there won't be hot spots in the future. I think there will always be hot spots. And to my mind, a hot spot is a location or type of property that provides above average growth, but for a very finite period of time. So you might have a suburb that is undervalued. They get some infrastructure, a highway or a hospital or something that really, or some industry moves into town or big employer or whatever it might be, something that changes the demand-supply dynamics, but not permanently, because it can't continue to perpetually climb. So you might get an area that's going to have 10% growth on average for the next 5 years, but then we'll just revert to, pretty ordinary growth longer term. There's always going to be those sorts of locations. There has been in the past 30 years, there will be for the next 30 years. The problem though, as a property investor, to try and invest in those locations, it's quite risky. You need to first pick it. You can't be too early because otherwise, you could invest in a location and get no growth for the first 5 years. So you want to pick the right location, buy it at the right time, then you've got to decide when to exit. Because if you're going to invest in something that's not going to give you that perpetual capital growth, at some point you're better off taking your equity and investing somewhere else. And so there will be locations in Australia that will outperform capital cities over finite periods of time. There's no doubt. I'm not saying that won't happen. It will happen. It's really just about trying to find the assets that are going to give you 7, 8, maybe 9% on average for a 30-year period, because that's really where you're going to do all the heavy lifting. That's really where you're going to really enjoy that compounding capital growth. And I would rather put my eggs in one really good quality basket and buy one great asset that's going to have those fundamentals than try and then end up with sort of 3 very average quality assets that might not perform as I hope.
Well, when you look at this quantity over quality discussion, I mean, every few months there's a story online, isn't there, that someone in their 30s has got 12 properties and you can do it too. And what's the trouble with that? And how do you see through to what's important?
Yeah, so I mean, I started my business in 2002, so 21-ish years ago. I probably looked at literally thousands, tens of thousands of different property portfolios. I haven't met one person that has been able to acquire a huge amount of assets that are of average quality. I've met plenty of people, or know plenty of people that have a very large property portfolio of several assets, but they're always high quality type assets. So the problem is that you can't, if you want average or above average returns, you can't expect to get those returns from a below average quality product or investment. It's just not going to happen. And it sort of stands to logic that the quality will determine long-term returns. At the end of the day, the sentiment, the market sentiment will determine short-term returns. And we only need to look back through the COVID period as a great example of that. Through COVID, those beachside or even regional capital cities were doing incredibly well. Everyone was deciding no one needs to be in the city anymore. We're all going to move to the coast or out to the country, and capital cities are over. Now, of course, that transition is reversing itself now. But in the short term, they became very popular and prices started to rise. It's really the long-term dynamics that ultimately are going to play out that are going to have a big impact on your investment portfolio. The short-term noise is always going to be around.
And of course, when you have got lots of properties by number and you're telling all your friends about it, I liked your analogy that it's like a person that's in business boasting to their friends about how many staff they have. Anyone with staff and lots of them quickly works out that that's not the goal.
Yeah, that's right. Look, I think, I've met people over the time that have come to me and said, Stuart, I want to buy 10 properties over the next 5 years.
Well, that's a classic one that I hear.
Yeah, or some sort of notional sort of number like that. And look, I think it's good to have financial goals, of course. Yeah, it's having some goals better than no goal, but they aren't particularly meaningful. I mean, we could all probably, or most people could buy another 10 properties over the next 6 months. It's just a question of where they are and how much they cost and, all those sorts of things. But there's a lot of people that could do that, but it's not necessarily going to get you where you're going. And this notion of I'd rather have one great property than ego-filled 5 property portfolio that I can go and tell family and friends at dinner parties on the weekend about. This notion sort of flies in the face of that and hopefully encourages people to realize it's quality over quantity. And that is even more important today than what it was previously. And the other thing, Jared, is that the number of properties won't pay your living expenses. 10 properties is meaningless compared to what your living expenses are. You're going to pay your living expenses in dollars, of course, not in percentages and not in number of properties. And that's the main thing to, I think, understand, that if you had one property, but in dollar terms, it's growing at a certain rate each year, more than what you could possibly spend in retirement, then that's the easiest way to really build independence. And what I did is I tried to demonstrate or help people understand how that compounding growth happens over time. And so if you look at $1 million property growing at 7%, and 7% is sort of long-term average growth in most major capital cities in Australia. So looking at over the last 40-ish years, 40 plus years. So that's a realistic long-term growth rate. If you have a look at that in the first 10 years, that property will be worth circa $2 million. It's doubled over that first 10 years. So you've made almost $1 million of equity or $100,000 a year. In the fourth decade, so year sort of 31 to year 40, and I know that's a very long period of time, but just to really demonstrate, the amount of equity growth you'll experience in that decade is $7.4 million. So your property is increasing by $700,000 a year. Now, in 40 years, $700,000 won't be worth what it is today, but it'll still be a whole lot of money and more money than anyone will ever really spend. So it's great to look at, okay, these are the number of properties, this is my portfolio, those sorts of things. But at the end of the day, what we really want to know is how much will our property appreciate on average every year? Because if I've got a relatively small amount of super, but then there's one property that's growing on average by $500,000 a year, for example, I don't have a problem. Like in terms of funding retirement, I don't have a problem. And so it's really about how do I invest or what property do I need to invest in so I do get that dollar value worth of growth on average over long periods of time, on average every year.
And I guess it makes sense then if it's going to be potentially we've all got more limited borrowing capacity, especially when interest rates move back to more towards their longer term average. We've only that borrowing capacity is a precious resource. So I guess that's why we need to be fussier with what we're looking to buy ultimately, because not everything is as likely to perform as well as it has done in the past. Not every property type, the tide is not as likely to lift all boats. And even if you're a betting man, it's a case of doing this with the least amount of risk and in the most optimum way, which is I've heard you say quite a number of times. So it's not to say that the other approach definitely won't work, but for me, it's like, well, if I want to do this in the least risky way, in the most optimum way with the most evidence behind it, where am I going to place my bet?
Yeah, it's a great point, Jared. I mean, a lot of investors think about return well before they think about risk, but it should be the other way around. It should be trying to de-risk your investment strategy as much as possible, which makes it very boring, of course. It's not investing in Bitcoin. That's exciting because no one knows. It could work. It could triple in value over the next year, or it could halve in value. No one knows, and it's exciting. But a good, sound investment strategy shouldn't be exciting. It should be really boring. And the reason it should be really boring is that you should take as much risk out of it as possible, or put it a different way, give yourself the highest probability of actually achieving your lifestyle goals. And so if we think about this logically, and I want to invest in a property today so that in 20 years it's worth 4 times its value, which is what it will be if you get 7% growth. What do I think is most likely? If I buy a property in this new build area that's kind of up and coming, but it's 40 Ks out of the CBD and it takes a long time to drive to, it doesn't have as much employment opportunities, all these sorts of things. Or should I invest in a location, a blue chip suburb that has heaps of evidence that have demonstrated that it's grown way more than 7% over the last 40 years, that benefits from finite supply and just increasing demand? They're my two options. Which one do I think has the highest probability of actually working? Well, clearly the one that's had the evidence, the blue chip suburb, but it's boring. And quite often as human beings, we like to try and take some shortcuts, but there are no shortcuts. And there's a great quote by Warren Buffett. He says, you can't make a baby in 1 month by getting 9 women pregnant. Some things just take time. And it's true. A good quality property asset just takes time. You can buy something that's a fantastic quality property, and in 10 years' time, you may or may not be actually better off for it. In 20 years' time, you'll most certainly be better off for it. Sometimes properties do take a long time to work, but really if you do want that strong level of compounding capital growth, something that is going to appreciate by several $100,000 a year, property is by far the easiest way to do that over a long time.
The other downside of purchasing that, less quality property that might grow sporadically and then do nothing for a long time is that if you decide to eventually sell out of that asset, of course, you're realizing, again, you're swapping around your assets, you're paying entry and exit costs. This is a lot of my trouble. When I started out, I did things all focused on the short term. So I made great money in that renovation. I felt like I was hands-on. I made great money in that development, but it didn't suit to hold the property longer term, or I was in with a partner, or, having a partner enabled me to do more quicker and feel like I was getting ahead. But then after a few years, you look back and it's like, oh, how much tax did I pay? How much GST did I pay? How much effort did I make? Did I really get ahead? And if I just let that compound out in a more quality asset over time, then, I'd be a lot better off today. So
there's a study by a fund manager in the US, I forget the name now, but they did this, a very large fund manager, and they did this study of the best performing accounts. And the best performing accounts, they concluded, was inactive accounts, people that actually passed away. So the reason they were best performing is that they weren't chopping and changing, that they stuck with one investment. They didn't sell down and buy and sell and do all that sort of stuff. They just stuck with one investment. Now, of course, sometimes you have to sell. Sometimes the best laid plans don't always work out. You can't just close your eyes and hope for the best.
It's not to say don't sell a property if you need to, and if your larger goals revolve around your home and you're fulfilling that lifestyle dream, what do we invest for? Well, if we don't get something out of it and can't realize those home dreams, sometimes it does need assets to be sold. So it's not, don't listen to a snippet of what we say and never sell anything.
Yeah, or maybe it didn't turn out how you hoped. Maybe you thought it was a good investment property, but it hasn't turned out how you'd hoped, and you've concluded that maybe it won't. In which case, then you do have to sell. But apart from that, if all you can do, and this is true with any asset class, whether it's property, shares, or anything else, if all you can do is go and buy a really good quality asset and then forget that you own it, which is not to say you shouldn't review it, but forget that you own it, so you just hold it for longer term, that's really the easiest way to build wealth. But the issue is that we, as human beings, like to tinker with things, and we think we're a little bit smarter, and maybe we could extract a bit more return, and so forth. But I mean, have a look at some of the older people today that bought property 40 years ago. There wasn't a lot of science to it. You speak to them and they say, oh, I just bought land value.
Yeah.
In these areas.
The simplicity of it really has to carry some weight too. You're waiting for some extra secret or, something that you don't know.
Yeah. Well, we think building wealth's a complex problem, and complex problems therefore should have complex solutions. But it's not true. The simplest solutions are often the best. They're the low cost, they're low risk, and they're easy to implement. And it's true with property, and it's no different to this whole property portfolio argument that, and you'll keep seeing there've been every few months for the last 20 years, there's an article of how some 30-something-year-old has acquired, like you mentioned before, Jared, 10 properties over the last 6 months or something. There'll continue to be articles like that. That's fine. That's clickbait, but the real focus should be really around how does it actually work, and how can I make a really good quality decision? And a lot of investing is really just basic logic. It's not any more complex than that.
Well, I think a couple of the hurdles, just to touch on, and maybe you can tell us how you've helped your clients get over them, is people say to me, oh, Jared, isn't it riskier having all the money in the one property? And I'd feel more comfortable owning 3 instead of this one. What do you say to that if someone's still not convinced?
I think there's a lot of merit in having multiple assets because it does spread your risk. It does spread your geographical risk. It means that, the risk of vacancy is lower. I mean, you might have 3 assets that all 3 probably won't be vacant at one particular time. Those different areas, different geographical areas will grow at different paces over different times. So on a portfolio level, it spreads it out. All those things are important, but important from year to year perhaps, but not so important over the very long term. Over the very long term, the most important thing is performance. And I agree that putting all your eggs in one basket buy in of itself isn't a great strategy. But if what you're doing is putting it in the highest quality basket you can find, then what it will do is reduce your risk and increase your probability of achieving your goals. So I would do it every day of the week. I would like, if you had the capacity to, it'd be great to have more than one property, of course, but if the decision was invest in 3 average quality properties or one awesome one is going to win every single day of the week.
That's presuming the person can afford to hold it and afford to keep it and, fits with their overall plan as well.
Yep.
Other thing people say is, it's going to take me longer to save up for that better quality one. I can see the market, increasing, and it's so tempting, especially when we're in Perth at the moment. It's like, well, I can see it increasing every month. It's going to take me longer to save. Like, what do I do?
And look, it's true, but if it was easy, everyone would be doing it. That's really the answer to probably a lot of things in life. The easy option isn't always the right option. In fact, the easy option...
It's just so tempting when you get a little bit of money in your accounts and you're like, I can do a deposit for a lower price one. I can do that now. And it takes a lot of discipline to just be like, no, I'm going to wait, keep saving, keep working the plan to the larger asset at that time later.
Yeah, and you got to be realistic too. I mean, if you're miles away from being able to...
Yeah, exactly. If your savings rate's really low, if it's really not going to change much even in 2, 3, 5 years, then, maybe you do need to look at, okay, I'm going to buy the best quality that I can afford and still get in the market, still have some return as opposed to no return for a long time or for indefinitely.
Yeah, or you might be able to leapfrog yourself and, do everything that we just said you shouldn't do, which is take a short-term decision and maybe then create some equity. So it's really about working out a plan. How do I get there? If you can't make it in one move, how can you do it? Do you need to really work on your career and your income earning capacity so it increases your borrowing capacity? If so, you can do that in the next couple of years. Maybe if you're a little bit weaker on equity, maybe go and buy something that you can renovate to create some equity to sort of improve your position. But at the end of the day,
And it's classic how people do that with their homes as well. And I know you've been quite an advocate of maybe getting to that dream home takes you a few moves. And, if you're handy and you're able to improve a house along the way too and do that without paying capital gains tax, then that stepping stone approach can work.
Yeah, definitely. And even looking at your home as like an investment itself as well. So, I mean, for people that, for example, had an average quality home from an investment perspective, an average quality investment property, maybe they'll be better off just putting those into one asset and then occupying a great investment property, for example.
People are surprised when I tell them this as well. They think I'm called Investor's Edge. I'm all about investing. It's only investment properties. No, the two things are completely related and the whole picture needs to be looked at.
Yeah. I think it's I read a book a few years ago called The Property Puzzle. And it really is, and the reason I came up with the title is it really is a bit of a puzzle. You got to put all those pieces together, like borrowing capacity, where I want to live, what are my goals, what's my cash flow look like, and then you've got to design the strategy that works for you. But the really important thing is to realize how is a strategy going to work. So if you're being presented with a particular opportunity, one of my wife's friends called my wife up and said, I'm going to see these property people. They've got this property. It's a new build sort of property and they reckon it's not going to cost me very much out of pocket. And, it's in this area. And it sounded like a great opportunity to her. And of course, Jared, you and I would know from just that brief description, she was being sold a property from a developer and it's probably not going to be a really good investment. So I think that's the thing that people need to educate themselves on is how is it going to work? Does it have the fundamentals? What happens if, borrowing capacity and incomes are stagnant in Australia for the next 20 years? How is the demand going to push prices higher on this property? And if that's not clear and there's no evidence that it's happened in the past, then all you're doing is throwing darts at a dartboard. But educating yourself about, logically, how can this work, I think is the best way to mitigate risk and also mitigate making a mistake.
Awesome. Well, thank you so much for your time today. I don't know if you could hear my thunderstorm and massive downpour of rain happening in background. I was trying to mute it out, so hopefully people can still hear you talking.
Yeah. Oh, well, it's good that it's raining somewhere else other than Melbourne for a change.
Yes. Thanks, mate.
Oh, good. Thanks, Jared.
Catch you on the next one.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.